Holy moly, how the tables have turned. The Federal Reserve has responded to this morning's CPI data. We've got a Nikki Leaks update. We've got so much to break down in terms of market expectations. We've also got to temper euphoria because we're still, we still got a December report coming up, okay? We'll talk about that. But folks, wow. CPI comes in cold. Let's talk about the reactions to that. In case you haven't yet seen my reaction, especially when my prediction was nailed right on, predicted month over month of 0.4 versus expectations of 0.6. That's what we got. Year over year, predicted 7.7. Market was expecting 7.9. We got 7.7. That was awesome. Core month over month coming in at 0.3 below expectations, and core year over year 6.3 below expectations. So great news. Now, what do we know? Well, here are some things that we know. First, we know that shelter inflation made up over half of the entire CPI move. That's insane. Half of the entire CPI increase was because of shelter inflation, which we know that rents have already peaked and they're going down, but CPI inflation is still trying to catch up to it because of the way they measure it with owner's equivalent rent. It's so stupid. But the point is, it is making up half of the inflation we're seeing now. And markets are saying, well, you've got a few different ideas, but markets are overall saying that we expect that to actually really meaningfully start rotating down and really drag inflation down very quickly sometime in 2023. Some market experts say Q1, JP Morgan says Q3, but either way, the consensus is, hey, rental inflation is expected to peak. Now, if you actually remove rental inflation from core CPI, this is not saying we're not having empathy for people who have to pay higher rents. It's just saying if you want to isolate where the inflation is, if you remove, and I tweeted this, if you remove shelter inflation from core, you're at negative 1%. The first negative read since May of 2020. That's insane. Okay, that's like the bottom of the stock market. Bottom was like March, April, but near bottoms during the COVID pandemic. Make sure you follow me on Twitter as well, @RealMeKevin. This is really good. So not only are you now seeing shelter inflation or core inflation negative when you take out shelter inflation, but you're seeing the Fed already respond to the CPI miss this morning in a great way. So Fed Harker had some chatting to do this morning, and he immediately picked up on the CPI report and now suggests that it could be appropriate for the Federal Reserve to pause at a Fed funds rate of 4.5%. This is a huge shift. Just last week, after Jay Powell's talk, we were thinking potentially markets needed to price in a Fed pause at 5.25, 5.5, and that sort of expectation started leading markets to say, well, what if it goes to 6%? And that's why we just saw this utter decay in the stock market, and it was very, very painful. Now, markets are pricing in a Fed pause at 4.865%, which is actually slightly above where Fed Hawker is. And anytime that terminal rate comes down, stocks tend to rally. Anytime that terminal rate goes up, stocks tend to fall. So if Hawker's at 4.5 and he's right, and the terminal rate right now is deemed by the market to be 4.865, and we see that come down, you can see continued pushing up of the stock market and a continued pushing down of the US dollar. Remember, the US dollar does really well when bonds in America are yielding more money because more international buyers want to come to America for the guaranteed rate that treasuries offer you if you hold to maturity. They're the only thing you could call a risk-free investment. And in order to buy treasury bonds, you have to buy the dollar. So the dollar's gotten really, really, really strong. But as soon as inflation peaks, we expect it to collapse. And the collapse of the dollar has already started. If you wanted to invest in the dollar. But before we get into that, I want to thank today's sponsor, MooMoo. MooMoo is an advanced one-stop trading app that makes it easy for traders to do any and everything they need. MooMoo offers an earnings calendar, which is a clear and customizable calendar that lays out individual release dates of financial reports for you. Being able to see when reports come out is so crucial for trading effectively, and having all of the reports listed and organized into one calendar makes things a lot easier than constantly trying to go around to different websites. That way you can get the information you need when deciding on your next big trade. MooMoo also offers fund tracking, which allows you to get a quick overview of the movement of funds in the stock market to help you make the best trading decisions if you want to see what the big boys and girls are up to. It's tools like these that separate MooMoo from any other trading platform. So at bare minimum, try it. Try it along the other platforms you're using and check it out. If you're a beginner, intermediate, or advanced trader, MooMoo's unique set of tools and trend visualizations make understanding market movements just that much easier. And in something like stock trading, it's those little things that can make all the difference. MooMoo is also giving out $10 of cash back when you complete your first deposit of any amount celebrating the company's 10th anniversary. Only available when you sign up via my link down below, and on top of that, the more money you deposit, the more free stocks you can get, up to 15 totally free stocks. Check out those terms and conditions via my link down below. Get that cash back, get those up to 15 free stocks, and for Australian users, it's up to $50 Australian dollars cash back when you deposit more. If you wanted to invest in the dollar falling, the way you could do that is through an ETF called UDown. That's UDN. That would be basically shorting the dollar. And you could see it has not performed very, very well. But recently and now today, it's starting to move up here. And recently it's been trending up in anticipation of the CPI report. If you think the dollar is going to continue doing well, you could always get U up, where you could see that recently the dollar has actually been falling a little bit. So a couple interesting ETFs that you could pay attention to. So if we look at some things well, first of all, you know, what does this mean for the Fed? And then if we look at some things that we can do, well, what does this mean for the Fed? It really means that if this CPI report is replicated on December 13th, which is when we get the next CPI read, which would be great, right? Then, and when I say replicate, I mean it's also either soft or it doesn't spike again. It could spike, and if it spikes, it just ruins all the optimism that we're on a sustained downtrend. But at 5:30 a.m. December 13th, so in a month and 3 days, we'll be getting the CPI read for December. And that's actually before the Federal Reserve meeting, which is really good because what matters more right now, killing jobs or killing inflation? And the answer is killing inflation. Like the Fed does not want to have to slow down the job market. If people can make more money by switching jobs and inflation is low, by all means, have at it. But you can't have a strong job market and high inflation because you potentially lead to a wage price spiral, and then you really have to rug pull the economy like Paul Volcker did and push us into a dirty, deep depression. So, could this report be the start of the Fed pivot? Now, that's different from Fed U-turn. Fed U-turn is when they're like, we're raising rates and now we're dropping rates. That's a Fed U-turn, right? And markets are anticipating and trying to price in that U-turn. A Fed pivot is like a 45-degree change, right? Where they're like, all right, we were going for 75 basis points in the next meeting, and markets were actually pricing in about a 50% chance of a 75 basis point hike, 50% chance of a 50 basis point hike at the next meeting. They pivot and go, okay, we're going 50. Psh, that's a pivot, right? A reduction in how much they're raising rates from either a higher level, like 75 basis points to 50, or from 50 to say 0. That's a pivot, different from a U-turn. Those things are very, very important to know. Because markets usually really rally off full U-turns, although we are getting some pricing in of anticipation of that eventual U-turn. Okay, so now, what are the expectations for a 50 basis point hike now? They were 50%. What are they now? Now they're 82%. And that's partially because WikiLeaks came out and tweeted basically that this sets us up for 50 basis points in the next meeting. Remember, WikiLeaks is the guy at the Wall Street Journal who always seems to get text messages from the Fed, and then he breaks the story. So he's the guy who's like, yeah, okay, we're probably going 50, and so markets are quickly adjusting to that, which is great. Now, it is interesting to note that you do have gold up slightly, and you have some calls for, well, obviously Treasury yields are falling on this. That's not a surprise. But you've got some folks saying that if you believe we're in a position of peak inflation, that's now behind us, and we're just off of peak inflation, we're not going to get a new peak, and we're going to continue to trending down. What are things that you should do? Well, here's some investments to consider. One, you could invest in bonds. You could buy bonds, and as long as inflation continues to trend down, you would likely expect that bonds would go up in value. Now, I want to be clear. and yields would go down, but you would hold your yield to maturity based on when you bought if you hold it to maturity. But you could also trade them. So I want to be clear though. While yes, I am a financial advisor, and yes, I have courses on building your wealth, whether it's stocks, 0 to millionaire real estate investing, learn everything I know about real estate. I think I know a lot about real estate, property management. If you want to grow your business income and be part of me with boot camps and actually really learn, join the Elite Hustlers course that's linked down below, right? You can get 60% off now. While I am a financial advisor and while I do have products related to education, I want to be clear that what I'm suggesting here is not financial advice. I can't give you personalized financial advice. I have no idea what your situation is. So bonds, you would expect to do well. That is, owning them, you would expect to do well. You'd expect the value of those to go up if inflation has peaked. You would expect tech stocks and cyclicals like ARK or Tesla or whatever to actually do very well if inflation has peaked. You would also want to probably cover shorts. You want to still be careful, in my opinion, and temper expectations for margin, right? I don't think you want to go all in YOLO margin right now. If we are at a bottom, which is a dangerous word to say, then going in margin makes sense right now, right? But if we get a dirty December 13th report, or indicators are that we're going to potentially get a dirty December CPI report, you could get screwed. You can get margin called. Terrible situation to be in. So covering shorts, good idea. With the exception of shorting the dollar. Shorting the dollar could actually be a very good strategy if inflation has peaked. Now, be careful though, because if you're going all in tech, all in bonds, and all in shorting the dollar, what do you have? Well, you have a recipe for disaster if inflation ends up going up again, because all of those will underperform if inflation goes up, right? So you really have no hedging in what I've just described to you. Now, Fed Hawker also came out and mentioned that monetary policy lags by up to a year. Now, Jerome Powell doesn't really believe that. He seems to think that, that the lags could be closer to 6 months or maybe even 3 months. But it's very interesting that you've got this Hawker coming out suggesting a 1 year lag, because that could really mean, yeah, we do need to pause now, because we're gonna have to start turning the money printer on maybe in October of next year or November of next year, because we've over tightened. It'll be really interesting. Could set up for a really nice bull decade. Is that being too bullish? I don't know. But get your 60% off. I'm still like shocked and nailed those inflation predictions. It's so freaking cool. Check that out via the links down below. And folks, thank you so much for watching. We'll see you in the next one. Goodbye.